Hey, how's it going, guys? It's Amir with Nobility Lending. I just want to go through a couple of questions. A lot of people have asked me a few things. They have a couple issues, and they want to know what I've seen in the investment world in general and why we even created Nobility Lending today to speak to an audience and see what other questions that they have.
So, what do you think is the investor's biggest problem today?
There's a lot of different problems, but you're not the first one to ask that. But I feel like right now, a lot of investors are overworked and they just don't have enough cash flow. They need access to good passive income, and they want to beat the S&P index and other traditional investments. They really just want to have time. Usually traditional investments don't have the cash flow to buy their time back. So this cash flow is really a big problem. And they also, from what I've seen at least, they just need access to higher quality passive income opportunities, which is why I kind of put this lending fund together. And some people have asked, hey, what are other investors doing out there and what is not working? Well, right now, a lot of people have invested in the stock market. As you know, we've seen a couple of dips the last few years, and there is some gloom and gloom about a possible recession. So, and some fear about what's going to happen to the markets with new presidents, new regulations, and things like that. So they're trying to avoid 20, 30% dip. Some people also got burned in the real estate market and they don't want to deal with tenants, toilets, and trash. With interest rates going up, commercial real estate is not necessarily the safest place. And so there are some people that just love the stock market index, but unfortunately, JP Morgan Chase has shown that stocks over the last 20 years, if you adjust for inflation, which a lot of people don't do, really only returns around 4% a year. But even if it did 8%, I'm not sure if that's even going to keep up with inflation or beat it by a little bit. So those are the main issues that I've seen.
So I know you were recently a keynote speaker at a New York economic forum. What did investors say they were looking for?
Yeah, so after I finished speaking, I just went into the audience, just asked them a bunch of questions. It seems like what they're really looking for is something in their portfolio that it's just kind of consistent fixed income. Even some people looking into real estate, they're not getting that consistent income. And a lot of people think like an interest rate, like an annuity, which sometimes gives just 3, 4, 5%. And it's not really significant enough for people putting in 6 figures, sometimes 7 figures. And the bonds are paying even less than that, depending on what type of bond you're getting. And then there are some stocks out there that do pay dividends, but we're talking about like 2% dividends. They still are not getting that cash flow. So they get a little bit frustrated because they want to live life on their own terms, just get something consistent. So that, at least the feedback I'm getting when I talk to people is something like that. They just want to basically buy their time back so they can hang out with their friends, their family, maybe renew some old hobbies that they have, like traveling or hiking. And some people just need some more time to take care of their health. And also, sleep's important, right, too. So, some people just want to catch up on sleep and not have to work overtime. So, if some people get enough passive income, they could take a whole month off, possibly, or maybe they just took 1 or 2 days off a week so they get some of their income replaced by passive investment. That could really help with some work-life balance. And that's actually the reason we set up Nobility Lending.
So what exactly are y'all offering to your capital partners?
Well, the Nobility Lending is an e-commerce lending fund. So we become kind of like the bank. What we do is we're going to lend to seasoned Amazon sellers with great products and a proven track record. And these people have ROIs per month north of 20%, usually 20 to 40% profit margins. And it sounds like a lot, but if you've been to any 7-Eleven or anything like that, the markup is huge, right? They're going to get Doritos or water bottles for $1 and you're paying $2.99. So you can see how they're getting some good ROI. And that's in a brick and mortar store. Imagine you don't have that overhead when you're in e-commerce. So what we do is we'll say, hey, we'll buy the product for you. We just want a small fraction of your ROI. And then they could be liquid for operations, or they could buy another product and scale up their business. So that's basically what we're doing. We're giving them that opportunity to be liquid. Plus, our back end often can help them get more sales, and we can even take over management from them if we needed to. So that's why we started this Nobility Lending, first come, first serve basis, 12% preferred return for our initial investors that are getting in this month, which is basically 1% a month. Also, when you get started with, let's say it's first of next month. After a year, you have 60-day liquidity. So if there's something else you want to do, just give me 2 months notice and you can put your money in something else. Or if there's an emergency, you want to buy a second home, no problem. They call that a lockup. So just 1 year lockup. After that, you can do whatever you want with the money. Or, a lot of people right now are actually just putting more money into it just to get even more cash flow. And that's also kind of makes us a little bit different because some deals are so long-term. Let's say a real estate deal might be 5-7 years. It's not bad to do those things, like definitely get your real estate going. But, it's good to diversify a little bit away from that and get a consistent 12% a year, like clockwork, paid out monthly, and have that liquidity. That's kind of what makes us different. But similar to real estate, we lend against a hard asset, which makes it less risk. So in real estate, you have the house. Here we have the inventory, and we're buying this inventory at 50 cents on the dollar. So imagine, would you want to put your money in anything where you're buying it at 50 cents on the dollar? Like anybody can make money like that, right? So that's why these people do it. They have really good relationships with the suppliers. That's why they get on those deals. So also, unlike real estate, we can sell these things quickly. Like we could liquidate a whole truckload of stuff in one day through liquidators or on eBay or something like that. We're talking like Curry K-Cups, Disney products, Barbie dolls, Adidas shoes. These are what we call quick sellers. That's unlike some real estate deals where what you lend on and trying to liquidate is probably going to take you at least 90 days, maybe a couple of years. So some people have described it to me as like, hey, this sounds just like a high yield savings account. It kind of is, except for that 1 year lockup. Other than that, you could get your money out when you want. You could put more money in. And the best part is you get true diversification because this type of lending is not correlated to the stock market, not correlated to real estate, not correlated to crypto, not correlated to life insurance. Doesn't matter if interest rates goes up or not. Doesn't matter who the president of the United States is. So,
and what do you mean by true diversification? Don't people get that with different mutual funds?
Some people, they think that diversification means just put your money in different things. But in that example you just said, like if you have different mutual funds, those are all in the bucket of public stock. So if public stock market goes down, everything you have goes down, which means you're not diversified. So true diversity means that there's not correlation with the different things you're investing in. So, the easy example is stocks and bonds, right? If stocks goes up, bonds usually go down and vice versa. So those are inversely correlated. And you could actually, there's numbers to this, like from 0 to 1. 1 means you're 100% correlated. So with us, we probably have some negative correlation with stock. And if interest rate goes up, we could probably charge more. Also, this is an arbitrage game, so we could always have that arbitrage. We're not going to lend unless there's a gap between, what they're paying and what their profit margins are, right? So this arbitrage thing is really market neutral strategy.
All right. Someone in the chat is asking, how does this lending align with investor interest?
Yeah, I don't know if I mentioned it before, but the type of 12% that people get is called a preferred return. So what does preferred mean? Preferred means that return comes before any of the managers make any money. So basically, you're first in line for any money. And that means if you don't get your 12%, we make nothing, which means basically like we're working for free. And, nobody wants to work for free. So the investors have to get paid before a fund can get profit. And sometimes people see this in other deals, like, real estate deals where you might get a 5-6% pref, which by the way, right now, they're not even paying that. But, that money gets accrued to investors before managers take anything. We're pretty much doing the same thing. And that's really what gives us a financial alignment with investors because we're basically putting our money where our mouth is. You're going to have more security because you're in a lower risk position, the whole operation. Plus, it outperforms stock market, outperforms bonds, outperforms precious metals, outperforms most real estate projects as well. And, that's part of the reason we like it. Also, we're not charging any admin fees or anything like that. So there's really nothing for us until investors get that 12% first.
So there are a lot of people offering returns online these days. Why trust Nobility Lending?
Well, that's a good question. So a lot of it is based on track record and experience. Right now, we have almost a 3-year track record. We've never missed a single payment in 3 years for our preferred return. Also, another thing is, let's say somebody does default, which luckily we haven't had any, but if somebody does, we have over 200 employees that help manage multiple Amazon stores. We're experienced operators in the wholesale space. So, that's unlike banks that lend to people. Well, if they lend to your business or real estate, they're not in the business of operating a business or real estate. They can't do anything. We're different. We actually operate it. We could take over the inventory and sell it. So in fact, when that happens, we're going to make even more money. So, all the profit margin that should have gone to them, we're just going to get that instead. A default actually would make us more money, although we don't want it. But if it does happen, we'll kind of have a smile on our face. But luckily that hasn't happened yet, but we're ready for it. Another thing is we have all the numbers. So we basically know what these people are buying the products for, because we tried to buy it, but we couldn't, because we don't have the relationship with, Barbie and Legos and things like that. So if we see the catalog and we see what the price is and we see what they sell on Amazon, we just do the math. We know what their profit margins are. So we're going to be lending to people with the highest profit margin, which is the biggest buffer. And so that's really a game changer for us, because we're actually we're underwriting the product. We don't actually have to underwrite the actual borrower or the business. Plus, we also put together a team of people that have over 50 years lending experience, a couple ex-bank presidents that have turned lenders. That helps a lot. And we're also lending on solid brands like Nespresso, Keurig, Disney. So that's what makes us pretty good.
And why is Nobility a good choice for this industry?
A couple things, not just our experience that I mentioned, but the timing of this, because large banks haven't figured out to do what we're doing. So, they might give a business credit card with some high interest rates, but they're very slow to do that. And they just don't understand the market or the seller's needs on how to expand. So we underwrite the actual asset. Banks are completely clueless. They're not going to call distributors and figure out what the margins are or the ROI, right? They're not going to they don't have software to analyze the store minute by minute basis like we do. And so this gap in lending is what gave us this opportunity where, we could generate double-digit preferred return for investors. So imagine, just like for a fraction of these people's profit, they're going to get some liquidity. They could grow and scale. We're coming in pretty competitive by charging them 2-3%, every once in a while 4% a month. Seems like a lot, but it's just a fraction of what they actually make. So we're thinking 2 to 3% is our sweet spot right now. And if that changes, then we can go up or down and it'll still be okay. And it's actually even better than factoring, where you have to look at future revenue and lend based off of future revenue. We actually have the product. So it's a pretty cool place to be right now.
Now, why is Nobility Lending Fund a better investment than its competitors?
Well, a couple things. When you look at the competitors, a lot of times their offerings might be closer to a bond or stock market returns like 5, 8%, 9%, or you might have to take higher risk. You might have to wait till some sale 5-10 years from now before you get a double-digit return. Here we're lending, we're in the first position debt, and we're just being the bank. So 12% is pretty much higher than most of those things. Plus we have that liquidity option after a year. So, it's almost like, think of it as short-term lending notes. And we do the same. We offer, our notes are usually 3 months at a time until we get to know the sellers a little bit more. And then we can give them a long-term thing. So that's why I think it's a pretty good deal. And according to Wall Street Journal, some of these other assets are really not looking like they're going to be resistant to a future recession. Or if you have some more low risk things like annuities and bonds, you're not beating inflation. So we're kind of in that middle zone where we're beating inflation by a good amount, but we're not taking so much risk trying to get a home run. We're just kind of middle of the road, chopping away and giving good returns.
And how has Nobility Lending performed so far?
Well, we started this a few years ago. I think we're getting close to 3 years, and we've never missed a preferred payment yet. So a lot of people have actually reinvested. We actually just kept it very private and only allowed current investors to invest. But now that we're getting some more introductions from distributors, we can reopen it up for the first time in 3 years for people that want to become capital partners with us. The pref returns to the investors are really great, and the industry of e-commerce is only growing. More and more people are working from home, and more people are just getting used to buying things and having it delivered to their doorstep. So it's still not taken over retail yet, volume of retail, but we know that's the way it's going.
So what will investors have after they invest in Nobility Lending?
Well, so basically, let's say somebody invests in Nobility Lending this month. First, you're going to feel pretty confident because you're going to see that our third-party administrator is going to reach out to you and get all the paperwork squared away. You have an investor portal. You're going to see your income, 1% a month coming in after one full month of investing. And also, if you have an IRA or 401k, you can invest in there. And we work with pretty much every single IRA. And they're happy to see us come on board. A lot of them already know who we are, so they already have our paperwork. That makes it even faster. And also, if you don't want to compound the returns, which is an option, you're going to get that cash flow. You're just going to feel good getting some cash flow, and you might start thinking about maybe taking a day off or taking a long weekend once a month, something like that. And another thing too, people can feel pretty relaxed because we're not holding people, in handcuffs or anything. Like after a year, if there's something better for you, then just give us a heads up. We'll give you your money back. We're not here trying to lock up anybody for 5 or 10 years. So, if there's an emergency, you need the money, hey, just let us know. We could liquidate in 60 days. You want to stick around 1 year, 5 years, it's really up to you. But right now is a good time. We have a good 3 to 5 year runway before it gets competitive. So we think this is the right time to make these moves.
And what's the downside of not investing in Nobility?
Well, I know some people are sitting in cash and basically it's guaranteed to lose value to inflation, right? There's not too many guarantees, but that might be one that we could say because the value of the dollar keeps going down. So that's good. There's also that opportunity loss because once we hit our next milestone, we're just going to close the fund just like we did before. And this time we're probably not going to reopen it. So there's only so much of this niche market we can do. And we just want to get to that level and then we're done. Or, some people want to gamble in the stock market roller coaster. I guess you could, but something stable like this is only going to be around for such a long time where we probably will be oversubscribed and might even have to return people their money based on the feedback that we've gotten so far.
Someone in the chat is asking, why did you even start Nobility Lending?
Oh, that's pretty interesting. Well, a couple of things. First, why did I even get into putting projects together in the first place? Well, my dad, who's a physician, actually went bankrupt when I was 21. That year, I didn't get into medical school. And I was thinking to myself, I need to be pretty diversified because my dad wasn't. And so I just constantly started studying different types of investments and personal finance and business. And I joined a bunch of masterminds. I've read over 400 books. And I even went so far, I got my securities license and spent half a decade boutique investment bank. That really taught me a lot. We actually went through over $600 million worth of projects in just that half a decade. I was able to co-manage some things with them and learn about due diligence. So now I can help other people prevent something that happened to my family and actually strengthen people's financials and get diversity. So it just kind of feels good that I can help people diversify and buy back their time. So that's one of the reasons. The reason is just we already had the data from all these suppliers. It's just a way to monetize our data. So most people don't have information from 6,500 suppliers, and all those suppliers have dozens of products. We have tens of thousands of products we've already underwritten. And so that's what's cool about that fund. Another thing that's cool about this fund is, we have that preferred return and we have a third party administrator and they see everything that we're doing. So people don't even have to trust me on this thing. They've got another person doing all the wires. So we're just kind of running everything on the back end with data that we've been mining for about 4 years now.
So people ask, Amir, how come people have not invested in e-commerce lending? Why do they regret not pulling the trigger?
One thing is people don't believe that it's even possible. Like if they're used to bonds and stocks, they're used to that 4 to 8% annualized return. They see something like 12%, they think it doesn't make sense. But there's a lot of people making double-digit returns in the alternative assets. So it might be their first time into that. Another thing is access. So when we started this, it was a very boutique fund, brought in millions of dollars very quickly just through friends and family. We didn't have the opportunity to actually grow bigger. So now for the first time, because of our distributor relationships, we're going to open it up to other people. So word of mouth has been great for us. And now we just want to get a little bit bigger, which also helps us get more diversified and gives us a bigger name in there in the lending market. So that's what we're doing right now.
So, Amir, you mentioned something really interesting there. What if an investor doesn't trust themselves, or what if they don't have the expertise in your industry?
You might not trust yourself to make the decision because you don't have the expertise, but that's why people invest passively in people that do have the experience, right? So I've been doing e-commerce since 2001, almost a quarter of a century, and I always share my information about the market with people on podcasts or my private wealth newsletter. So you don't really have to know the industry or trust yourself, but you do need to find the people that have experience. But not knowing the industry doesn't mean that you shouldn't pull the trigger on something like this. So, for example, let's say your kid was sick. You're going to go to a pediatrician. Just because you don't know the medicines that your kid might get doesn't mean you're not going to work with a pediatrician on accomplishing your goal. It's kind of the same thing here. And combined, with our whole team, they've lent out over $1 billion already with the bank presidents and lenders we have on our team. So, all the experts we have and the track record.
So, Amir, what if investors are doubtful because they haven't had success in their past investments?
Well, that's probably true for anybody that's invested enough. Like if you invest in 100 things and you're batting 100 out of 100, I want to meet you tomorrow. So eventually there is risk with everything, but the goal is to win more than you lose. At least for me, it's also to beat the S&P index by, almost 40, 50% more return. This one is a little bit more simpler. So maybe in a previous failed everybody's different, but maybe in a previous deal, they didn't really understand it. This is pretty straightforward lending. Everybody has borrowed money from a bank. Now we're just on the other side. But there's definitely no guarantees in life. Who knows? The government might ban lending. Amazon might be called a monopoly and they get shut down tomorrow. There's always some type of weird risk. But in general, this has higher risk-adjusted returns than almost anything out there, especially in the alternative investment space. And you have that preferred return. So basically, if we don't perform at least 12%, that means we're not making anything. So we're not going to get up and work for free if we don't think there's a good chance we're actually going to do what we say we're going to do.
So, Amir, I see people that are asking here, can you explain in detail or tell me a story of somebody that you know that was pretty satisfied?
Yeah, well, one story comes to mind. I know that, actually, unfortunately, somebody was in a divorce and they had to pay some monthly alimony or child support, but that person just put in enough money to where that covered all of it. So they park their money with us and the returns go monthly. He just gets it toward alimony. He doesn't have to even think about it. He doesn't feel like he's actually giving the money out. The money is parked with us and he's just giving the returns. Some other people that wanted to go down to working just 3 days a month were able to do so. And after a couple months of getting the payments, and they put in some more and they built it up until they could go down to 3 days a week. So that was pretty cool and pretty life-changing for some people. So there's a couple of success stories that just off the top of my head I can think of.
All right. So that's about as much time as we have today. Are there any final thoughts, anything you would like to add before we go?
Well, if you have any questions, you could reach out to us. I just want to remind people you should never put more than 20% of your portfolio in any one investment. And also we do have caps. So there's only based on how much money we have now, we might limit how much you could put in. That cap's always changing. So, whenever you're on a call with us, we could figure out what is the minimum and maximum that you can do. And we're going to open the first of the month on a first come, first served basis, pretty much open book. If you have any questions that are more specific to your unique situation, then just let us know. That's what we're here for.